Today we're going to talk about CMHC, mortgage insurance, what it is, how it works, and everything you need to know about it so you can get into your next property. Chances are you're looking at buying a property, and more specifically, you're probably looking at buying a property with less than 20% down. CMHC is basically mortgage default insurance. It's not there to protect your interests like most insurance you might buy. It's insurance that the bank makes you buy if you are technically falling into some kind of high risk category. If you're putting less than 20% down, the bank is going to have it as part of the requirement in order to qualify you for the mortgage that you buy this insurance. So how does CMHC work? How is it priced? And how do you go about qualifying? Well, generally across all big 5 banks, you're going to find that if you get CMHC insurance, the qualification criteria for a mortgage actually becomes a little bit easier. Why? Because now you have an insurance policy backing you up. And it's actually a pretty good tool and service because it offers a win-win for both parties. CMHC is going to protect the lender's interest by guaranteeing their mortgage, and they're also going to allow you to put less money down, and they're not going to ask for that money up front. The way it works is that if you go to a bank and you get pre-qualified for a mortgage, and then you want to buy a property that maybe is a little bit more expensive, you may end up putting less than 20% down on the property, and therefore your risk assessment is going to be going up. But how CMHC helps you is that they're going to make you less risky by protecting the mortgage. And at that point, if the mortgage with a lender is protected, the lender is going to get a little more relaxed on the qualification criteria, meaning that you will have an easier time when it comes to how far your income will go to qualify you for a mortgage, as far as how much down payment you need, and a whole bunch of other factors that may be negatively impacting your ability to get a mortgage. So it's just going to become a little bit easier. Now, how much does CMHC cost? Now, here's where we talk about the tier system. If you're putting 5% down and anything less than 10%, you're probably looking at around 4% of a fee built into your mortgage. That effectively means you have something in and around 1% equity in that property at that point in time, because 4% of your 5% down payment just got chewed up in CMHC fees. That doesn't sound too great, but if you really think about the value of being able to get yourself into a home, it may make sense. But now where you see a drop off in the fees associated with CMHC is going to be at the 10% mark. They're going to charge you around the 3% fee, just a little above. And then if you go anything higher than that, I think around 15%, they're going to be charging you something like 2 point something. You have to decide as a home buyer or as an investor, if you're buying a triplex or something like that, where you're going to be moving into the property as well, moving into one of the units, or house hacking. My assessment on it is that it will almost always make more sense to either use no CMHC insurance and put 20% down, or go full and use the whole 5% down and then pay the 4% rolled into the mortgage. Because if you're not planning on refinancing the property for a long period of time, you're going to be able to carry that mortgage through, and it's not going to be a lot extra payment to have that insurance policy in place rolled into your mortgage. But therein lies the question: should you go for CMHC insurance in order to buy a property? And that's where we need to break down some of your financial goals. We need to have an understanding of what your intention is, what you're trying to do. If you want to hold a property for maybe 1 year, CMHC might not be the best option for you to go with. When it comes to mortgage insurance providers, do we have different options? Well, the most common one we hear about is CMHC, which is why we're talking about them in this video. But you also have other companies like Canada Guarantee and Sagan. But the important thing to understand about CMHC is that it is an excellent tool and very good for people who want to get into homes that are priced under $1 million. 5% down payment is an option provided to you by banks and is going to be insured by CMHC. It doesn't mean that CMHC is going to be the one giving you the mortgage. If you're qualifying for a mortgage and they're allowing you to put down 5% on a property, that means that they're going to let you put 5% down onto anything up to $500,000 in value. But what happens if you want to buy a property a little bit more than that? 5% is going to be the calculation for anything up to $500,000, but the rest of it between $500,000 and $1 million is going to be calculated at 10%, which means that if you buy a property at $750,000, you're going to pay $25,000 down payment for the $500,000, and then you're going to be paying a 10% down payment for the other $250,000. So then you're looking at a $50,000 down payment. So is it worth it? In my opinion, CMHC is an excellent tool for you to use, and I highly recommend it. If you want to know more about real estate investing, or you want to get in touch with us, make sure to join our Facebook group where we share all kinds of information about real estate investing, as well as have links to our local meetups and other educational material. Make sure to like this video, subscribe to our channel, and I'll see you on the next one.